Welcome to our second official IPA 2.0 webinar. Before we begin, I just wanted to say a few things about how to interact with us. If you guys have a question, you can ask the question in the chat window or the Q&A window. The chat window is public, the Q&A is private. That's the only difference. If you want to come on and ask your question live, just raise your hand. There's a little hand at the bottom of your screen there, and we'll bring you on live to ask that question. David's going to be fielding the questions today as I'm presenting. Feel free to interrupt us at any point and ask your question, especially if you don't understand something. That's the whole point of this, is to elaborate on those areas that you don't quite understand. With that, I want to introduce to you my partner, David Andrade. He has been instrumental in helping get us to this point with IPA 2.0. He's actually helping to market it as well. This webinar isn't about IPA 2.0. It's more about how to quickly analyze a note and to price it correctly. I do want to put out there that if there are questions related to the software itself, just let us know. But we're not going to focus on that today. We're just going to focus on the note stuff. David, did you want to say anything?
Yeah. Thank you, Joe. Again, good afternoon, everybody. Hope everybody had a great holiday weekend. It's deserving, and hope you had a great time with your family, friends, or whatever you did. I will be here monitoring any questions you may have, and you can ask questions at any time. I'll interrupt Joe and to answer your question. Joe, go ahead.
And I also want to say, for those of you who need help downloading IPA 2.0 or getting it set up, especially if you're already an existing user, please set up an appointment with us, and we can kind of go from there, especially with existing users, because the existing users have to be set up a little bit different because we're offering them a free upgrade to 2.0. So just let us know, either email myself or David, and we'll get you set up. Now, what I've done is I've gone ahead and already input an asset in here because we're not focusing on IPA 2.0 application. We're more looking at how to use it as a tool to identify a good strike price and to analyze a note that has hair on it. So this particular note has some hair on it, and I'm going to kind of walk you through what that is and how to properly set your strike price accordingly. So as you can see, this property is in Georgia. It's a non-performing note. It's first position. The unpaid principal balance is at that the seller has provided us is at $205,726. The original loan balance was at $199, and the reason why it's flagged in red right now is because the unpaid principal balance is higher than the original loan balance. And what that means typically is that there's either a loan modification or some kind of fee tacked on to the original loan balance, and we don't know what that is because the seller hasn't provided us that information at this point. In some cases, the sellers will provide collateral, but I would say 90% of the time, 95% of the time, you're not going to get that collateral until after your indicative bid goes in and you enter into that grace period for doing your due diligence on the note. So with that in mind, we're going to assume we don't have that information, and we're moving forward just to identify whether or not this is a good note worth pursuing or not. Most people will just assume that $205,000 for the balance is the UPB, but I'm going to show you that it's actually not, and that if you're placing your bid based on that number, you're leaving money on the table, and I'm going to show you how. And so what I'm going to show you right now is I'm going to go ahead and take a look at the AM schedule, and we're going to look at how it lays out. So there's quite a bit of hair on this one, and the first thing right off the bat that we see is that there's 14 years of delinquency. So number one, either it's just been sitting there and the lien holder hasn't done anything because they don't want to move forward with foreclosure or COVID or who knows what happened. But I can tell you this, that it went delinquent in 2008, which was right around the time where everything started collapsing. So maybe this was one of those deals that got shuffled in a big pile of deals that hasn't been touched for a while, and now they're just trying to unload. So with that in mind, if we take a look at the SAM schedule, we can see that the buyer paid for roughly, a year, maybe a little over a year. They have 20 payments into it, and then the rest are delinquent today. So this basically shows us when the current date is. This is the current pay period, and that they are roughly 168 payments delinquent. They're 14 years delinquent. The statute of limitations in Georgia is 6 years. So we would have to deal with that moving into this, and we would have to know that and account for it and put any expenditures associated with that into this analysis as well. That said, the other thing that I'm looking at is what is it going to cost the buyer to reinstate this loan? At this point, the buyer has to basically pay the lien holder $294,894 to reinstate. Now, the likelihood of that happening is pretty low, but we'll get into that as well. This also includes the difference between what the seller is providing us and our reverse calculated unpaid principal balance. So the seller's provided us this $205,726. We reverse calculated the UPB based on the dates provided and the AM schedule information that the seller has provided us. So this is the true UPB based on the information the seller has provided us, $197,000. The difference between the two is $8,458. Now, that $8,000 is money that would be left on the table if you were to bid on this note and bid on that $205,000. The reason being is because at this point you don't know if that $8,458 is fees. You don't know if it's a loan modification. You don't know if any of it's interest bearing or recoupable. You have no clue at this point. So you have to assume that none of it's recoupable, and you have to place your bid based on that notion. And we're gonna go through that, and I'm gonna show you how to do that when we get into the analysis. Are there any questions to this point? With that, I'm not gonna change anything. I'm gonna leave the seller's unpaid principal balance in there, and we're gonna go right into the analyzer. Now, I've already pre-run the analytics on it and brought in the information from the internet. We're looking at an ARV of 343,000, and based on that ARV, we're assuming that the as-is value is going to be less, and this is way overkill, and it's significantly less, given the fact that this property was built in 2002. It's probably going to be more around that $320,000 mark, but we're gonna, for conservative purposes, we're gonna leave it at 280. Now the seller has said, I'm looking for 75 to 80% of UPB on this non-performing note. Now most people out there would say, that's just way too high. I'm not paying that kind of money on a non-performing note, especially one that has hair on it. Well, I'm here to say that if you look at the numbers and you understand them, paying a little bit higher percentage on the non-performing isn't necessarily a bad idea. We've actually purchased notes over that are non-performing at 110% before, and we've made money. So it really comes down to what your return is against each exit strategy as you look at those. Now, when I was saying that if you base your offer price off of the UPB that the seller has providing you, in this case it's the 205,727 here, your offer price is going to be that 75% of what that number is, and it comes out to 154,000. what you're doing is you're giving the seller money because that $8,000 that's questionable right now, you're bidding against. So what we do is we say, okay, if that's the case, I'm going to go back to my AM schedule and I'm going to send the difference to IPA, which is basically going to change the UPB to this calculated UPB. And it's going to set the $8,458 into a corporate advance category that's non-interest bearing. So when I come back to analyze it, you'll see that the UPB has changed from that 205 down to 197, and that we've actually accounted for that 8,400 in the lender advances. So we're not actually bidding, we're placing our bid only on the unpaid principal balance at this point. So our offer price goes down. And now you can see that we're at 78% because so there was a 2% difference. So that 2% could mean a lot to a lot of people when they're looking at tight margins. So if I wanted to recalculate my offer price at this 75% of UPB, all I really need to do is recalculate my my offer. Now instead of the 154, I'm at 147. So what I want to know from this point is, okay, based on this offer price and the value of the property, moving forward, what does it look like if I were to reperform this? I mean, and the likelihood of that happening, we already know, is pretty low, because to fully reinstate this property, it's going to cost the borrower $294,000. Now, if the property is worth $343 and they have to fully reinstate at $294 and there's only $145,000 in equity, the likelihood of them doing anything is very low. They're, most likely just going to walk away. So this would be a good candidate for maybe a cash for keys kind of deal. And if you can't do the cash for keys, we would want to look at the foreclosure and how that foreclosure unfolds. So we come down to our foreclosure exit strategy, and the question that we ask is, well, what's our maximum bid? And currently our maximum bid would be set to $453, which far exceeds the value of the property. Now, if we wanted to set our bid at a strike price, or I should say a return price, like for instance, in this case, I've set it to 20%. So I've basically said the minimum I'm willing to make is 20% on this deal. If I want to make 20%, what's the minimum bid amount, or where do I start my bid at auction? And the answer is $194,000. So if I start my bid at $194,000 and the property is worth $343, what's the likelihood of me selling this at foreclosure to make that 20%? It's actually pretty high. In fact, you can probably start the bidding a lot higher, maybe even 50%. So we can come down here and we can actually change that 20 to 50, and we can take a look at it. Now it's at 50%, and our minimum bid set at $243. Still, that's a really good deal, and it'll probably sell for that amount at foreclosure. So we'll leave it there and we'll say, okay, we're going to start our bid at that, 243 mark to make that 50% return. Now you can see right off the bat, we're paying 75% of the UPB. Okay, our strike price is at 147. We're fairly confident that the borrower is not going to reinstate, and we're probably going to go through a foreclosure process. We already know that we also have to deal with statute of limitations and get that corrected. So that's going to cost us a little bit of money as well. So we might want to boost up our legal fees accordingly. So what I'll do is instead of $5,000 for attorney fees, I'll say $10,000, just to give me some cushion. And with that $10,000, I can recalculate everything within the system. And what this will do is it'll change the returns and annual returns and so forth. Now
You're not
we,
saying, I'm sorry, Joe, he's not, I mean, he adjusted the price I mean, the amount to 10,000 as an example. It may not be, but typically we'll have a little bit more hair. It will cost a little bit more money. So some of these other costs may be adjusted as well. So,
well, we
okay.
can put it at 20,000. We can put it whatever. What it's
10, I think 10 would be good.
yeah. So right now we have that accounted in with the foreclosure legal fees, and with all of that in there, we're still looking at 250 starting off our minimum bid at foreclosure. The likelihood of it selling at foreclosure and us getting that 50% is pretty high. So we're trying to mitigate risk here, and we're trying to figure out how to properly purchase this note and what our potential returns might be if we were to get to this point. Now, let's say, for instance, nobody bids on this and it just sits there and you take the property back. Well, in that case, I'm going to look at wholesaling it. And now I have additional fees in there, like closing fees and agent fees that I have to deal with. So my overall capital invested goes up, just like it did with the foreclosure in adding legal costs. And with my overall capital now at 179, I started with 147, now it's at 179. And my as-is value set at 214,000, which it's probably really low. I'm thinking this is going to be more like 300. I'm going to put it at the 300 mark because this is a fairly new property and there's probably not a ton to do on it. And I think that 43,000 is plenty of any kind of fixing that you have to do to the property. It's going to be plenty. And if you wanted to sell it as is, I think that 300 is probably a fair price for that.
Hey, Joe, real quick, I do have a question. A question came in from Cindy. She had asked can you please go over again why the max bid at foreclosure is $453,007?
Yeah, it's that much because there's so much in the reinstated amount. So they have to fully reinstate at 294. Plus there's going to be arrearages on it that are unforeseen. Plus, that corporate advances are on top of that. So there's a lot that goes into that number, and I could probably spend an hour talking about that. And Cindy, if you want me to go over that in detail with you off this, I'm happy to do that.
One more question, Joe. Linda asked, are you licensed in Georgia, or do you avoid that going through your servicer?
Typically, you're going to go through a servicer that's licensed in whatever state that you're dealing in. So if you're going to purchase this note and you're going to purchase it in Georgia, that servicer better be licensed in Georgia. Otherwise, you could get into trouble. So make sure that your servicer is licensed in the state that you're doing business in.
Thanks for the questions.
Okay. Now, going back to the wholesale aspect of it, we took the property back, and in taking it back, and our capital invested at this point being 179,000, which it could be more or less, depending on what it took to get to this point legally. We're looking at roughly around a 52% overall return or a 33% annual return. And the reason why we break it down like this is because everybody wants to understand what their annual return is on their money rather than the overall return. So we're into this about 17.7 months. And based on the time frame that we're into it, our overall return is 33.1%. That's what we want to look at. So if we're doing the analysis and we're understanding that we're at this 33.1% on the wholesale, and up here we're at that at the 50% mark, and we started our bidding at 250, what we could do at this point is we can say, You know, in this case, it doesn't make sense, but if for some reason your minimum bid was approaching the value of the property, we could say, okay, well, let's pull back a little and let's put this more in line with the wholesale at 33%. And that way you're starting the bid less and you're incentivizing people at auction to place bids based on that. Again, one thing I want to point out on this foreclosure, which I didn't mention before, is that if this maximum bid, for whatever reason, is less than your, actually, if let's say your maximum bid was 350,000, okay, and it sold for 400, which in this case it wouldn't. What happens to that $50,000? Typically, that $50,000 goes back to the borrower. There are other things that, you know, if there's liens against the house or whatever, that $50,000 will go back to paying the liens. But typically, if there's nothing else to be paid back, that $50,000 goes to the borrower. So you're not always entitled to the full equity at foreclosure. Just keep that in mind. But when you analyze it and you start with a minimum bid and you go into it saying, hey, this is what I'm willing to take at foreclosure if I set my bid properly. And right now we're saying we're setting it at a 50% return. Our minimum bid's 250. The value's at roughly 343. There's a huge upswing for somebody to come in and buy this property at foreclosure. The likelihood of it selling is high. Let's say it doesn't sell, we get the property back. Now we're wholesaling it, and we're saying that the value at the wholesale is 300,000. At that 300,000 mark, we're saying we're going to make an annual return on that of about 33%, which is still really good. So you're covered all the way down to this point. Now, when we get down to this point, we want to determine what's our best strategy. Do we just wholesale it out of the gate like this, or do we maybe turn it into a rental, or maybe there's a fix and flip opportunity here? So we take a look at the rental analysis and we say, okay, well, based on renting it, the market rent right now is at $2,400, and our net cash flow at this point, getting to this point, is $792. Our overall capital invested is $189,678. So you can see our offer price started at $148. Our overall capital invested at this point is $189,000. To get to this point to rent it, it took 18.8 months, and then we're looking at holding it for 36 months and then selling it. That's what this analysis is doing right now.
Hey, I want to just to point out something as an investor myself. You always want to look at all your exit strategies. And any type of real estate that I invest in, I want to see all these exit strategies. So even though this note, this example is hairy, a lot of hair, based on your bidding on this and being successful, you have all the exit strategies. So this is really a strong opportunity for sure. It shows right here. So anyways, Joe.
And so one of the things to keep in mind when you're looking at the rental, you want to be aware of the cap rate, the gross rental multiplier, and a recoup period. We've added a few things in here that talk a little bit about that. For instance, you know, the higher the cap rate, the investment is more risky. This has a very low cap rate, which would indicate this is a lot less risky. Now, it's less risky from the standpoint that, you know, once you take that property back, you're in a good position to rent this. Now, with this rental, you're looking at an annual return of 13.7%, an overall return of 80%, and this is over that over the full time frame, which is 54 months, with a profit of 151,000. So this gives you an idea, and you don't have to sell it at 36 months. You can set that to whatever you want, and you can analyze it and keep it for 5 years. You can keep it for a year, and then sell it as a rental to someone else if you want. But this really breaks it down nicely. And if you want to further analyze it and get into like BRRR, where you finance it, you want to know what your net cash flow is, you can go into the finance tool up here rather than, you know, calculating it by hand. You can bring a lender on board. You can set it at, you know, whatever you want to pull out of it. So let's just say it was 100,000. And you got that money at a rate of, let's say 8%. And let's just say that it's interest only. And actually, let's not put interest only. Let's put a point on it. And so what we'll see is we'll see our net cash flow goes down accordingly. So now we've taken out 100,000 at 8%, and our cash flow went down to 59. It's still positive, but now we have $100,000 in our pocket, and it's cash flowing. But based on this analysis, it's going to take 269 years to recoup that at this rate. So it's maybe not realistic to take that much out, but you can take, you can find that happy medium, and you can look at that BRR and figure it out from this analysis. That's just my whole point here.
Hey, Joe, real quick, another question. Linda asked, but for the purpose of velocity of money, would it be better not to rent the property, not to rent it?
Yes, so if we're looking at all of these different exit strategies, that's what we're comparing right now. So we just looked at wholesale. The wholesale was gonna, if we take off the finance tool over here, the wholesale was gonna yield us 31.1%, right, for our annual return. We're looking at a rental right now that's gonna yield us 13.7%, but it's gonna do that year on year for, you know, 54 months essentially. So we're a little over 4 years, and the overall return is going to be 80%. So, you know, it depends on the type of investor you are and what you're trying to get out of it. If you're looking for cash flow, that's one thing. If you want to sell it, get in and get out, that's another thing. 13.7% return on a rental is actually considered pretty good. So, you know, that might be the way to go. On the flip side, there's also an analysis where we look at a fix and flip. Now, in this case, this is a fairly new property, so I highly doubt, you know, there's a whole lot of fix and flip going to happen here. But let's just say we had to put 42,000. Right now, we have it set to a low fix and flip. We could set it to a medium and recalculate our budget up here. And now it's at 73,000. And we can look at the high end of the market, okay? So if we come back to our comps here and we're saying, okay, well, our low end looks to be roughly around 260, 230 on the low end. Our high end looks to be around 400. So if we go and we say, okay, we're gonna shoot for that high comp. Now, the square, I always look at the square footage. In this case, the square footage on this comp's at 1860. Our square footage is at 2100. This is a 4.3 and we're at a 3.3. So we could actually add another bedroom with this square footage if we wanted to, and we can come up to this high comp or get close to it. So, and this is what we did when we first started Revival Brothers. We were buying notes and we were foreclosing on them where people were walking away, and we were rehabbing them. And we would do exactly this. And we would set our price at, in this case, at 400 or that 399, and we would come down a little bit. So let's just say we set it at the 380 mark, or 385. But knowing that we're going to try to exceed the high comp, which is that 400 mark, and then we look at our rental costs, and in this case, we're putting in 73,780. And based on our all-in, which would be 254,000, we're looking at an annual return of 22%. So if we start to look at all of these exit strategies, you know, it makes a lot of sense to sell it out of the gate and make that 31% if we were to take this property back. But we also have other exit strategies too that we can exercise here. We could do seller financing on it. We can, and once we do that seller financing, we can sell partials. We can do all kinds of things, creative things with it. But at the bare bones of it, we're looking at wholesaling it, you know, whether or not we have the value. If we have the value, we can do whatever we want from there. And renting is one of them, and fix and flipping is another. If this was at that 400,000 mark, what would that look like? At the 400, we're looking at a 26% return on a $73,000 renovation. Now, 73,000 is a lot. You know, you could probably put another bedroom in there and get everything done on the inside for, I would say 40 to 50,000 very easily. And if we put it at 50, you know, we're now very close to that wholesale number, and we have a budget for our renovation. So at this point, we've analyzed the note. We have a strike price set at 75% of UPB. We have a return that's very healthy across the boards. We know what the play is here on the asset because the likelihood of it getting reinstated is very low. It's not going to happen. It's going to go into foreclosure. We know that there's hair on it. There's legal fees that have to go into it. And if we need to bump our legal fees up, we can. And, and our play here is to take the property back. And if we don't take the property back, to sell it at foreclosure. So that's how you analyze a strike price. Now, let's say that you're not doing it. You haven't done any due diligence to this point. You don't know if there's back taxes on this. You don't, and it's quite likely there could be back taxes on this. But I would probably say there's not, because it's been since 2008 and nobody's bought this at a tax auction. So somebody's paying the taxes, and most likely it's the lien holder who's been paying them. And but you don't know until you dive into that due diligence. And in order to do that, you just go to the county's assessor's office. You look it up, see if there's anything owed on it. We have taxes already calculated in here at $43.69. Now this is based on 2020. Typically, it's not going to raise too much. If it does at all, it's maybe going to be a couple $100. And this 2020 is based on what was available online when we pulled the data. So you can verify that, and you can start to fine tune your numbers accordingly. We also have insurance calculated in here. We have other things like winterization, cash for keys. We have some assumptions in here already calculated on top of our offer price that's feeding our returns, which makes this even more robust in understanding or getting closer to the true return that you might see once you get to any one of these exit strategies. Did you have a question, David?
No, I did not. No, not right now.
Okay. So that is it in a nutshell. That's how you very quickly look at an asset, analyze it, look at different exit strategies, understand the hair on it, and what the potential play is going to be once you acquire this note. What are you going to have to do? Obviously, there's hair on it. There's legal that has to happen. You're probably going to want to get an exceptions report when you're in your due diligence phase, meaning you've placed your indicative bid at that 147 mark, and now you have that grace period of a week or two, however many days the seller is giving you to do your due diligence. You find that exception report, you make sure that title's clear. If there's issues on title, you get them rectified. You know that you're going to spend money on doing that, and you apply it accordingly. So let's just say that 10,000 for foreclosure is more like 15,000. which it could be. You don't know. There's a lot of hair on this, and I know people that are on this call that have spent up to 20,000. Sure, Cindy's going to raise her hand anytime soon.
Right.
So at 20,000, you know, we're looking at our returns, and you know, they have gone down, but they're still healthy. It's still safe. So from this point, I would say, okay, well, let's start to look at our worst case scenario. What is the worst case scenario? Let's say the seller isn't going to take less than 80%, or somebody else has a bid in that's higher than yours. Okay. So you want to put in 80%. You're going to recalculate your offer based on that 80%. Now you're at 80%, 150,000 in. You're looking at a minimum bid of 272, which is, you know, if we recalculated our ARV, which is still a lot less than the value, right? So the likelihood of it selling is still pretty high. If you took the property back, you're still looking at a 26% return. Anything above 20% return is a home run in my book. So
Absolutely.
you could theoretically, you know, go in and offer that 80% of UPB, and if the seller comes back and tells you, hey, well, it's not 80% of the balance I gave you, you can say, well, it's 80% of the UPB, and you can have that conversation with them, and you can go back and you can say, well, listen, there's $8,453 that's unaccounted for. Can you tell me what that's from? Is it did you do some kind of loan modification at some point? Or are these fees that that went towards the borrower for non-payment? What is that? And you'll get an answer, and you'll find out whether or not it's interest bearing. If it's interest bearing, then you can tack that onto the balance, and you can bid against that. Anything that's interest bearing. But if it's not, and the likelihood of you recouping that, I would leave it out altogether. You know, so that's how you start to really dive into these notes and get the numbers set straight. Of course, there's due diligence that still has to happen. You're still going to want to, you know, check to see if there's any liens, mechanical liens, any kind of liens against the property. It could be a lien sitting at the county because the grass wasn't cut. You know, it could be anything. I mean, there could be, your property could be in an area where it's affluent and there's an affluent tax or something. I mean, I've seen that before. But you want to do your due diligence. You want to make sure that you're covering everything. But I will say this, that it's not all that important to do all of your due diligence before you submit your indicative bid, because you have the ability, once the seller has approved your indicative bid, to further your due diligence. And if there are issues related to the note, meaning there's exceptions that need to be accounted for on title or whatever it is, maybe there's allonges that are missing, you know, maybe there's some unforeseen liens that you didn't see when you were initially doing your due diligence, you can bring that up and bring it up to the seller at that point and fade your bid accordingly. And if the seller doesn't accept that, then you can pull out of the deal altogether. I will say this though, don't enter into a bid unless you have the capability to follow through. Because if you enter in and you're wishy-washy and you don't know what you're doing, and you know you come to the final days, you know, before you're supposed to fund, and the seller's asking, you know, are you okay with everything, and you haven't done your due diligence on it, and you pull out, you're going to get blacklisted, and you're not going to be able to purchase anymore through that entity. So
Yeah, hey, Joe, another question came up. Question about boot camps and classes. Do you and Sabrina have any education boot camps for classes for note investors?
we do, yes. And if anybody's interested in getting together with Sabrina and I, you know, just give me a call, email me, and we can get you set up. We're actually working on quite a few things at the moment. We're working on not just the note side of it, but we're also looking at rehabs and and alternative investments, mostly in the rehab side of it. We're doing Illinois at the moment, Ohio. We have a whole system set up in place that we're going to be pushing fairly heavily, because we actually have a steady, we know where to get the assets, let me just put it that way, and the assets are coming in consistently, and we know that we can hit specific benchmarks on those. So that's happening. We're looking at creating an area where people can actually log into some of these webinars and look at the videos. We're trying to get those videos online. The problem that's been in the past is we just haven't had time to do it, and we're at the point now where we think we can make it happen.
Yeah.
So yeah, to answer your question, we've got lots of things going on. Give us a call, set up an appointment with us, and we can kind of go over what we have and kind of listen to you and what you're looking for, and maybe find a happy solution for you.
Yeah, with our experience, and besides notes, we have other types of experience as well. So if you have any questions, we're more than happy to answer those. We do love the IPA because it gives you all the exit strategies, and we use it daily as well. So.
And David has a phenomenal amount of experience in flips and rentals and holding property and all that kind of stuff, especially in Florida. So if you guys have any questions related to that, feel free to reach out.
Yep, absolutely.
Okay, so are there any questions up to this point? I know that was kind of a lot to take in, but you know, especially for people that are fairly new, I didn't want to really focus on IPA too much, but I wanted to illustrate how easy it is to go through a note, one with hair on it, and arrive at a strike price that actually works for you, where most people would shy away from it because of the hair. So hopefully I was able to communicate that with you today. If there are questions after this, feel free to reach out to us, and we're happy to help out.
Absolutely.
David?
Yeah, there's no questions yet. I mean, any questions, feel free to ask. We're here for you. It could be notes, it could be real estate, it could be anything in reference to that. So let us know. And you know, Joe, this is a good example, I think, of not just a typical note. This is something beyond, you know, the typical note. There's firsts, of course, that don't have late payments. There's seconds, depending on what position they're at. And then this is Harry. So this is just a little bit beyond non-performing, but based on the exit strategies and what we're showing here, you still can be comfortable and confident to buy something, this kind of asset.
And you know, it's funny you mentioned that, David, because you know, there's been all kinds of studies done, and what ends up happening is a lot of people will spend money, lots of money, doing education. I'm not saying education's bad; it's actually pretty good, but they'll spend all this money doing education. The sad part is 90% of those people will never buy an asset because they don't have the confidence to do it. And and you know, I think that confidence is probably the one thing missing in a lot of education out there. And if a tool can give you that confidence, then why not? You know, I mean, it could launch you into a whole new career. Who knows? There's a question here: how often is the software updated? It's updated almost on a weekly basis. Last update, I think, was a couple weeks ago. We have an update coming out today, actually. So if you have a copy of it, make sure that you click on that update button. And if you have the old version, the 1.0 version, make sure you schedule an appointment with us to get you set up on 2.0, because it's a completely different build, and everything is 100% different on it. So
yeah, I highly recommend to do the upgrade. Excuse me. It's definitely helpful, and a lot of other features in there as well. So it's definitely, everybody should be on that. And any questions about it, of course, reach out. and we'll be reaching out to you as well. We have 10 minutes now left for the webinar. So any other questions, feel free to answer, ask any questions, and we can we'll answer those questions for you. The exit strategies that you mentioned, I mean, right away you talk about confidence, and yes, right here a tool that's used just for that reason. I mean, it gives you those exit strategies immediately, and right away it just intensifies your success in helping you in this process. You won't find this type of software out there. It's very unique and specific to this nature. And man, I loved it as soon as we got together, and I use it all the time with my investments. So it
looks like
that show. So anyway,
it looks like we have a question here. Somebody's asking, can they get your contact information? You might want to. That's in the Q&A area. You might want to give them that.
Okay.
David.
Yep.
And somebody says, I'm new to this information. May you give me a brief explanation on the term hairy, performing versus non-performing. Okay.
Yes.
So
I knew that was going to come up, Joe. I knew that.
Yeah. So hairy basically means that there's multiple things that are wrong with there's usually a reason why a property has been sitting there for a period of time without any kind of action on it, especially through servicing. So what does that mean? That means that, if in 2008 they stopped making payments, if we take a look at our AM schedule again, it looks like they made payments up until 2008. So we already know that the 2008 recession hurt this borrower. I mean, that's pretty obvious. That's what happened here. Now, who was the lien holder at the time comes into question, and why didn't the lien holder go into foreclosure with this? Well, you got to keep in mind that at the time when all this was happening, there was all kinds of furloughs happening. There was extensions on foreclosures. Foreclosures were actually shut down altogether. There was all kinds of things that would make it very difficult for a lien holder to move forward on a foreclosure. So that probably happened. It probably went into a huge stack of notes, and out of those notes, maybe it was on the bottom and never got touched until now, and somebody wants to unload it and unload it quickly. And they know that there's a lot of hair on it. The statute of limitations is hit. They know that there's going to be some expenses on legal to get through that statute of limitations, to also get through foreclosure, to also get the servicing back in line, to contact the original borrowers to make sure that there's communication there. There's hair on it. Yeah. There's things that have to happen in order to get this this asset either performing again or through the foreclosure process. Now, in most cases, you're saying, how do I reperform that note? That's the question that most people ask. And in this case, it's probably not going to happen. They just owe too much money. It's just, they're not going to reperform. So the question is well, they're basically living for free right now if they're still in the property, and they're not paying a mortgage or a rent. The question is how do you get them out? And the only way is through foreclosure. And then once you go through foreclosure, you have to go through an eviction process. If they don't leave, the sheriff is going to have to show up at the house, and they're going to have to evict them accordingly. So people that know how to work the system know how to do it very good, and you have to find legal representation that knows that and knows how to work around that as well. That's what we mean by hairy. Not only that, there could be title issues. We don't know yet because we haven't seen the collateral on this particular asset, but there could be title issues where, you know, you can't even foreclose until the title's cured on it, right? And what does that mean? That means that you either have to figure it out yourself or hire a company to do an exceptions report and let you know what it's going to take to cure that, to cure the title so that you can move forward with foreclosure. That's
Right.
what we mean by hair. There's a multiple things that could happen. We just don't know, but we want to account for it. And we want to make sure there's enough money there that we're not going to lose on the deal when we purchase it.
Yeah, based on your bid, you know, you have that safety net right there for these issues that could come up. And as Joe was saying, there's something about the note that needs to be, you know, cured or something about it. So that means there's more of a discount. So based on the exit strategy that you're going to see, it's confident and comfortable to know, okay, well, that makes sense. I'm okay to do it, that kind of thing. So, but you still do your due diligence. And something does really come up that doesn't make any sense, then you can cancel out. Another question came up, Joe, from Stacy.
Okay.
They ask, is the tool for sale, meaning IPA? How much? And do you have instruction guide and how to use the tool?
Yes, it is. You go to our website, revivalbrothers.com. There's a tab there called IPA. In fact, I think I have it open here. Let me see.
We have 5 minutes left. So any other questions, let me know.
Just going to our website right now to show you guys where to go, and it'll kind of explain everything for you. You just go to Property Analyzer, revivalbrothers.com, go to About IPA, and it talks about it, what it does and how it works. There's a video on it. You can purchase it. All the purchase information is here. If you want the automation version, it's roughly $1,000 plus a $25 a month for the data plan if you want everything automated when you bring in that data. Or you can just have the manual version and input the data yourself, which it operates exactly the same. It's just the data doesn't come in, you know, automatically for you. That's all. It's only a difference. So yes, to answer your question, it is available, and you can go to our site to purchase it. And yes, there is information related to how to use the tool. In fact, in every sheet, there's a little video at the top that tells you how to use the sheet, and there's additional videos and tutorials throughout the whole thing. There's also a glossary at the end where you can look at videos online, you know, for different aspects of it. And we're always adding videos to it as well. So there's also this glossary section which explains calculations, it explains different terminology. What is a cap rate? What is cash on cash? You know, what is a GRM? How is it calculated? Why do I care about it? It explains all of that. In addition to, in the application itself, you can mouse over any of these areas that have this red triangle on it, and it explains a lot more about that function and what it does and why it does what it does.
Hey, Joe, another question. Fred is asking, can you talk a little bit more about statute of limitations?
Sure. So in this new version, what we thought would be important to add is the statute of limitations. Each state has a different statute of limitations. And, you know, when you exceed the statute of limitations, it's not that the note isn't any good or the lien holder doesn't own the note. You just have to go through a legal process to reinstate that I guess the ownership of the lien itself. So, and to basically wipe out the statute of limitations to start over. So there is a legal process that has to happen, and this is why we put this in there so that you're aware of that. In the state of Georgia, for example, there's a 6-year statute of limitations. We're at the 14-year mark, so we're way past that. So there's definitely going to be some legal action that has to take place before the lien can be reinstated to the lien holder as, you know, basically a clear lien. to move forward with anything like foreclosure, or taking the property back. Now, if there's issue on title, that's a whole nother story. Something in addition that you have to clear. And again, that goes back to the story of hair on the asset and what you would need to do in order to clear everything so that you can move forward with foreclosure.
Yeah, just to emphasize what Joe's saying, being confident, you contact the professionals at hand, the attorney. I had experience with that as well, where that was a question that came into hand. So the attorney mentioned to me on this one asset that I was bidding on, he just said, as we were foreclosing, they just would do a quiet title action, and that should suffice that in that state. And so that was the answer I got from the attorney. So yeah, each state is different. You got to ask those questions, and yeah, you'll figure it out.
And one thing we also have added in here is information related to the statute of limitations. So we have links that go directly out to areas online that talk specifically about statute of limitations related to specific states. And all of this correlates to our software and what you're seeing here. So also with the foreclosure as well. So any of these links will go to foreclosure sites that talk about foreclosures in the specific state that you're interested in. And redemption periods are also important. What are the redemption periods in specific states? Well, one of the things that we have in this software is we have a redemption period that is tacked onto your overall time frame. So if the redemption period was 2 months, 6 months, that time frame would get tacked onto your overall timeline for the analysis on your annual returns, which is super important. And these are things that are overlooked a lot of times when you're doing simple calculations on your returns. But this software actually takes into account a lot of expenditures and information that you wouldn't otherwise maybe overlook. We've even gone to the steps in the AM schedule to take a look at what those expenditures could be. So if you were doing due diligence, for example, what's the average cost for title reports, O&E reports, any kind of lien reports? What is servicing cost you when you're dealing with a hairy asset? It's going to cost more than your $45 a month on a performing note. I guarantee you that. How much does it cost for a credit report? What about a BPO? Photography, recording fees. There's fees that a lot of people don't talk about that are tacked on top of your bid that have to be accounted for. And we have things in here that you can add if you're doing an analysis on strictly a performing note. You can come in here and you can add those numbers in here, and you can really start to fine tune your overall return. So I know that we're at time right now. I want to thank everyone for coming. I don't see.
Joe, I had another question that came in. Do you want to answer it, or do you want to answer it offline?
Yeah, sure.
Yeah. So a question came in, and it asked, "Is there a list of properties your company provides us you can have to go search for properties yourself?"
Yeah, we actually have. The Rivaldo Brothers has also established a trade desk. If you go to our website, rivaldobrothers.com, you go to trade desk, you can sign up to get access to our trade desk. You'd have to log in to get it. Anyway, I'm happy that everybody was able to join us today. Thank you for coming, and we will see you next month on the first Tuesday at the same time, noon. And if you have any questions in between then, or you want to maybe have a one-on-one with us to talk a little bit more about IPA, or you're thinking about purchasing it, give us a shout, and we're happy to help you out.